Dear digital friends, welcome to the fourth episode of Spot and Forward. Our guest today, Alastair Newton, has been working with lfma for 3 years now, and therefore I think he doesn't need any introduction. Suffice to say that he served in the United Kingdom's diplomatic service for over 2 decades. Today, he is a leading expert on politics and geopolitics in the context on financial markets. Alastair has been promoting the History Rhymes thesis in the context of contemporary geopolitics for almost 15 years now. He continues to believe that there is much both for policymakers and investors to learn from history, and nothing that is happening in the world today should surprise us. This is why lfma has invited Alastair to Luxembourg again. Welcome back, Alastair. I'm very happy to see you again. I'm sure that our members would like to know more what they can expect at this stage of geopolitical cycle. Your first 2 slides are a brief recap of the cornerstone of your presentation in May. That example, History rhymes that to make informed decisions, policymakers and investors alike need to learn from the past, but also understand what makes today's crisis different. How has your big picture thinking evolved since then?
One thing which is clear, just sitting here today back in Luxembourg, which is a great pleasure, is that the weather has changed. When we did our recording in May, the sun was shining relatively. Today it's grey and dull, which is a pretty fair reflection of the way in which geopolitics have moved in the intervening period. If we think about where we are today, the world is a noticeably grimmer place than it was even as recently as May, and the outlook is grimmer still as we move into winter. Having said that, overall, one would have to say that the evolution of geopolitics, perhaps particularly here in Europe with the Russian invasion of Ukraine, but also in Asia with the escalation of tensions around Taiwan, has moved very much in the way big picture, which one would expect at this stage in the geopolitical cycle, which, as you'll recall, we discussed at some length in the last Spot and Forward we did. One thing I would say is that since then, I actually took the time and trouble to find out what Mark Twain actually did say, which is misquoted in this famous quote of his that history doesn't repeat itself, but it does rhyme. And what he said, as the slide shows, is that history never repeats itself, but the kaleidoscopic combinations of the pictured present often seem to be constructed out of the broken fragments of antique legends. Now, I have a rather painful pun on kaleidoscope, the toy that children have which has shifting colorscapes, and turning it into collide, as in collision. And what we have going on in Europe today is a collision between 2 ideologies, Western democracy and Russian imperialism. So the kaleidoscope analogy, to my mind, works particularly well. And of course, if we go to the 3rd slide in the slide pack, it also fits very well with the quote which I used last time, which is Francis Fukuyama, what he actually said about man's propensity to struggle against perceived threats, including a struggle against liberal democracy once liberal democracy has been established. Again, exactly what we're seeing here in Europe today as the Russian imperial decline continues and unfolds. And what we have in effect is President Putin falling into a slightly novel version of Thucydides' trap, which is declining power, Imperial Russia, fighting a proxy war against, well, we could argue whether the West is a rising power or not, but in relative terms, that is the critical factor. Russia in decline relative to the West, including relative to the European Union, starting a proxy war against Ukraine.
You have noted on many occasions that you are not an economist and no expert on central bankery. But there is no denying the key role of politics in driving inflation and the potential political consequences of fighting it. What do you see as the main political issues here?
I think civil unrest is a real possibility in Western Europe during the coming months of winter. Now, we are seeing a lot of action by governments to try to stave off the worst impact of rising energy prices. But let's keep in mind that a lot of those actions are actually going to be driving inflation even higher, or to risk driving inflation even higher. And the central bankers are going to have to strike a very fine balance indeed. It's still not clear that the Eurozone is going to go into recession. Latest data are, shall we say, unclear, mixed even. But the prospects are not looking good for what looks to be a very tough winter ahead. And this is Putin's moment of maximum opportunity, and the politicians and the central bankers have got to try to get this balance right if they are going to avoid a sharp decline in popular support for continuing to support Ukraine's war efforts against Russia. Now, as it happens, the Ukrainian offensive around Kharkiv in particular has come at a very timely moment, because Ukraine making advances on the ground will, I think, help to bolster popular support in Europe for continuing to back the Ukrainian efforts against the Russian invasion. But the central bankers certainly have their part to play in this, and they have to be really careful about how far they take interest rates in order to get this balance right between chopping back on inflation and at the same time not cutting growth too far.
History teaches us to expect an uptick in nationalist sentiment in times such as this. Clearly, the European Union is no exception. You argued in May that Europe would emerge from the current crisis stronger. Do you still believe this?
I do. I still very much believe this. It's actually very interesting being here in Luxembourg and talking to some leading European experts who are more sceptical about Europe sticking together than I am, including some of your senior members. And I can quite understand that, but standing back and considering the progress which Europe has made jointly, it is quite astonishing, and we shouldn't forget that Europe has been far, far more cohesive since the start of this crisis than anyone, including the Europeans themselves, actually believed was remotely possible, let alone likely. And I do think that although the going is definitely going to get tougher, that will continue to be the case. I thought, for example, that although it was by no means conclusive, the summit of energy ministers organised by the Czech EU presidency earlier this month was actually quite impressive in the degree of progress which it made. Legislation related to energy-related matters is slow for sure, but the European Parliament is continuing to move forward. We're recording this the day before Ursula von der Leyen makes her State of the Union address to the European Parliament. But I think that too, by the time your members see this video, will be seen to have been another positive step forward by Europe working together. Now, clearly, there are threats to this. The Hungarians remain something of a problem, to put it mildly. But what we are also seeing, which I think is something of a counterweight to these threats, is a shift in the balance of power within Europe itself. I was in Helsinki earlier this month, and Finland, of course, is very much what I refer to as a frontline state in the struggle against Russia. And if one looks at the way in which decision-making has evolved in Europe over the last 6 months or so, those frontline states are having a much more potent say than one would previously have expected. Look at, for example, the European decision on restricting visas to Russian citizens, clearly driven very strongly by the frontline states. This is partly through their own efforts. It's also partly, of course, through the fact that we have weaker governments in Germany and in France than one might have been seeing this time last year, or even more recently if one considers France and, for Macron, the disappointing result of the French legislature elections, which clearly have weakened his authority not only in France but also in Europe. So I think this combination of factors will continue to keep Europe broadly together, although there will be bumps in the road, there will be slow progress on some issues, there will be disagreements, but driven by the frontline states and, let it be said, by the European Commission, which is playing a very strong hand indeed in this, I'm personally confident that Europe will continue to act cohesively and effectively, albeit not as quickly as some of its critics would wish.
Following on from this particular concern, today revolves around Italy and its next government. How big a threat to European cohesion do you think a government led by Giorgia Meloni poses?
I think there are two dimensions to this which we need to consider. Since we've been talking about cohesion versus Russia, let's deal with that one first. Meloni has been very, very staunch supporter of Mario Draghi's policies on dealing with the Russia-Ukraine crisis. In other words, very pro-West, very pro-NATO. Now, clearly, we have to consider the fact that she's going to form a government with Matteo Salvini and Berlusconi involved in the government, and both of them are, may I say, famously close to Putin in many respects. And there is a risk that they will try to undermine her determination to stand firm with the Draghi approach to Russia-Ukraine. But I do think that if we look at the likely balance of parliamentary seats in the next Italian government, that Meloni is likely to control sufficient seats to keep her two coalition partners broadly under control. So I do expect Italy to stand firmly with the current Western alliance on Russia-Ukraine. The second dimension to this, of course, is Italy's own economic travails. And I do think there are some interesting questions which will need to be dealt with very promptly here. By definition, the new government is going to have to go back to Brussels and seek some modifications to the existing terms for NGEU bailout funds. I don't think they are going to get much slack from the European Commission. I think there will be a willingness to fine-tune the programme within the existing parameters, but anything which is going to go outside of the existing parameters, I think the rest of Europe is going to say no. And this could lead to friction, some market noise, and so on and so forth. A few weeks ago, the Financial Times had a very informal survey about the new ECB bailout mechanism, the TPI. And the question was, will Italy receive bailout from via the TPI? And I was very surprised that something over 70% of FT readers who responded to the question actually said, yes, Italy will. I'm skeptical because if Italy stands by its obligations under the NGEU bailout terms, I don't think it will need TPI. And if it doesn't stand by its obligations under the NGEU terms, I don't think the ECB is going to use TPI to bail it out. So in a way, I think the Meloni administration, assuming that the polls are right, will be in something of a corner, and they will have to, reluctantly probably, largely comply with the terms which Mario Draghi has agreed. And that will avoid the sort of bust-up in Europe which we have seen on a north-south basis over the last decade or so. Let's also keep in mind at the same time, the Italian 10-year government bond today is at 3.9% or thereabouts. And for all the lurid headlines which this has attracted, I personally can't get that excited about 3.9, compare it with 5.9 a decade ago. And what it actually does tell us is even the large amount of hedge fund money which has gone into betting against Italian government bonds is not betting against the continued existence of the euro. At 3.9, investors are telling us they do not see an existential threat to the euro. That is a big change from a decade ago, and I think it is a right change.
Turning to the war itself, despite the seeming success of ongoing Ukraine offensive, we still seem to be locked in something of a stalemate military, and sanctions seem to be having limited, if any, impact on Putin's ability to keep fighting. Where do you see this ending?
It's very hard to determine where things are going to end. There are many unknown factors moving around in there at the moment. If one reads the Western press this week, for example, in the light of the Ukrainian success on the ground, there's all sorts of chitter-chatter about a potential threat to Putin's continuing presence in the Kremlin. And there has been a petition led by local government officials in Petersburg calling on Putin to resign even, though notably not mentioning the war, which of course is a criminal offence in Russia today. So a lot of uncertainties around. In particular though, we need to be realistic about sanctions. Seizing oligarch super yachts is jolly good TV and all that, but it actually doesn't have any significant impact on Russia's ability to continue to prosecute the war. And anybody who thought that sanctions were going to quickly defenestrate Russia's military capability clearly has not been looking at the way in which sanctions operate. Having said that, however, sanctions are working. They're just working slowly, which is how sanctions normally work. And the sanctions which really count are not the flashy stuff you see on TV. They are the restricting of Western technology being exported to Russia. The sort of technologies which it needs to keep its oil fields running, its factories running, its economy running as a whole. Combination of that, the withdrawal of Western corporates from Russia with all the advantages which they have brought to the Russian economy over the years, and perhaps most of all, the fleeing from Russia of some of Russia's most valuable intellectual capital in the form of people who have decided just to up and leave the country. These will gradually bring Russia's economy to a grinding halt, seriously deteriorating its ability to prosecute the war and indeed to keep its citizens reasonably calm and comfortable in the process. Now again, this is history rhyming, if you like, because what we're seeing is something very similar in many respects to the way in which the Soviet Union went in the 1980s. Except, as Holger Schmieding, the chief economist at Berenberg Bank, remarked in an article published in August, I think this is going to happen somewhat quicker in the case of Russia than it did in the Soviet Union. Where does this leave us in 5 years' time? Who knows? Because clearly, Putin, or whomever succeeds him if he doesn't last that long, is likely to take dramatic action in some way, shape or form to prevent this continuing decline. And what way, shape or form that may be, who knows? And I'm going to be particularly gloomy here. You'll remember the last video we did. The final slide was speculating over the possibility of Russia deploying battlefield nuclear weapons. I still can't rule that out.
Meanwhile, energy prices continue to drive inflation. While gas is the central focus in Europe, where do you see oil going as the G7 attempts to impose a price cap on Russia's exports?
Again, a lot of moving parts, very difficult to forecast with any degree of confidence where this is going to finish up. If we take two sort of extremes, we still have Ed Morse, top oil analyst at Citibank, forecasting somewhere around 70 at the end of the year, which is consistent with what he's been saying from April. I can't gainsay that. I can't rule it out. On the other hand, we have a number of very eminent and expert oil analysts who are saying that the attempt to cap revenues which Russia is receiving from oil will drive the price up, and we're looking at maybe 140, 150 again. We also know, with a reasonable degree of confidence, that Mohammed bin Salman is looking to put a floor in the price of Brent crude at $100 a barrel. Interesting though that after OPEC Plus agreed its admittedly fairly marginal cut in output at its most recent meeting, we've actually seen the price of Brent go down since then, and it's back in the 80 to 90 range earlier this week, and as far as I know still is there. Putting all of these reasons together, I wasn't at all surprised talking to investors here and in Helsinki last week and indeed in London over the last few days, that the near consensus amongst those with whom I've been speaking is somewhere between $80 and $100 a barrel. And that certainly fits with my own view. You may recall that in the podcast I did for the LFMA at the beginning of the year, I suggested that probably $80 to $90 a barrel at the end of the year. And although I could quite easily be wrong about that still, a lot will change in November when the Americans stop pumping oil from their strategic reserve. Various measures which the European Union has agreed are supposed to come in around that time. I still have seen no reason whatsoever definitively to shift from my original forecast of $80 to $90 a barrel.
The 20th National Congress of the Chinese Communist Party will convene on 16 October and presumably confirm Xi Jinping as a General Secretary for an historic third term. Concern persists that his re-election will clear the way for military intervention in Taiwan. Do you agree?
I don't agree. I do not agree. I think there are any number of reasons why Xi Jinping will stay his hand as far as any really dramatic military action over Taiwan is concerned. And I don't think his reappointment, re-election, if you prefer, as General Secretary of the Chinese Communist Party will make any difference to this. First and foremost, Xi Jinping is watching very closely the way in which the West has responded to Russia's invasion of Ukraine in terms of its economic sanctions in particular. And I do firmly believe that he will wish to place China on a stronger footing to deal with a similar barrage of sanctions were he to decide that military action against Taiwan was absolutely essential and necessary for China to take. And right now, China is still far too dependent on a dollar-based international transactions system for starters. And although they are continuing to build the capacity and credibility of the e-yuan as an alternative payments method, they are still some way from being at a point where they could avoid some of the very dire impacts of the punishments which have been inflicted on Russia by using the dollar as a weapon to all intents and purposes against Russia. Secondly, China has more than its fair share of domestic problems right now. We still are having COVID lockdowns. Some Chinese tell me that they think that after the party congress is out of the way, there may be some easing of the zero COVID policy. We shall see. I think none of us can be sure of that and exactly what's in Xi Jinping's mind on that. And obviously that is having a negative impact on the Chinese economy. The real estate situation is having a negative impact on the Chinese economy. Consumer confidence isn't particularly high. China is not immune to energy price hikes, food price hikes, pork, although inflation in China is low, pork prices are high. This is a domestically highly sensitive issue. So all of that has to be dealt with. And then, of course, you have the increasing pressure on China in the form of the technology and the finance war. And in particular, let's just mention technology. America earlier this month telling NVIDIA that it could no longer export chips which China needs to continue the advancement of its own technology programs. So I think Xi Jinping will stand firm for the time being, which doesn't mean that I think that an invasion of Taiwan is off the cards. I just don't think it's something which we need to worry about in the short to medium term.
China and the US have reportedly done a deal which will prevent Chinese companies from having delisted in the US. Given that many of those delisted are tech companies, did this surprise you? And do you think the deal will hold?
I had a long series of exchanges with my former colleague, friend, and sometime partner writing, Richard Windsor, who writes a blog called Radio Free Mobile. And Richard is a genuine technology expert, and we do some work together on the tech war and on the related matter of the finance war. And what we're talking about here in this question is actually the finance war. And this is where I believe investors really need to concentrate their attention at this time, not on Taiwan, but on technology and the related finance war. As far as the tentative deal, let's be clear, between the US and China on audit requirements for Chinese companies listed in New York is concerned, Richard and I have not quite managed to agree on that. He's quite bullish about it. He thinks it will go through, and has been arguing that for some time. I'm a little more tentative. In terms of economics, it actually makes total sense for this deal to be concluded and to be implemented properly. But the political factors are not so favourable. In the same way as there is bipartisan agreement in the US on preventing US high-tech semiconductors going to China, there is also bipartisan agreement that China's tech companies should not be able to benefit and prosper from American investment. Effectively, American investors are financing China's technological advances. And let's keep in mind that as long ago as 2016, pre-Trump, eminent sinologists in Washington were describing China's technological advances as posing, and I quote, an existential threat to US primacy. Now, this is not to be underestimated as a factor. On the other side of the coin in Beijing, it is now absolutely clear that Xi Jinping is determined on making pretty much everybody and everything in China accountable to the Communist Party of China, Chinese Communist Party. And public ownership of a company clearly does not fit total CCP control, because the shareholders demand to have a say as well, quite apart from any requirements which auditors may want. So we are seeing a lot of companies retrenching to listing on Chinese stock markets rather than on American stock markets. There is a glitch in all this, of course, because one of the more interesting things which has happened this year as far as Chinese listings are concerned is that Chinese companies have raised 5 times more capital on markets in Europe this year than they have in the US, principally London and Zurich. But even that tells us that Chinese companies are looking to move away from America, which is perceived as being the biggest threat in terms of suddenly cutting off the supply of capital in some way, which could be to the detriment of Chinese companies, China, Chinese economy, and China as a whole. So moving to Europe as a halfway house kind of makes sense. We'll see what happens with this deal over time. And let's keep in mind that, as always with these things, signing the agreement will not be the last word. If the agreement is signed, we also need to watch very carefully exactly how it is being implemented by the two parties. Because what is clear at the moment is that whatever it says in the papers which are on the table right now, that those words are already being interpreted in different ways by the authorities in Beijing versus the authorities in Washington.
You told me you have recently been reading Danger Zone, The Coming Conflict with China by Al Brands and Michael Beckley, a novel based on war between China and the US over Taiwan, breaking out in January 2025. The authors argue that a key factor behind the timing is that China is in fact in decline. Do you agree?
I think the thesis which the two authors are putting forward is actually a very interesting one, and it takes me way back to 2002 when I was working for Lehman Brothers, and I and my then colleague and still collaborator on occasion, Rob Subbaraman, published a major report on China's prospects for the then next 10 years from 2002 to 2012. We boldly predicted that on average China's economy would grow by 8% per annum over that decade, which in retrospect we all know was a severe underestimate. It in fact grew by 12 to 15% per annum over that decade. And yet At the time we published, we were roundly and soundly attacked by the China bears, who at that time were as numerous as they were vociferous. China was on the verge of collapse, non-performing loans, middle income trap, etc., etc. It could not sustain that sort of growth level over the course of the next decade. In the 20 years since then, China bears, if not extinct today, are certainly an endangered species. And there seems to be this very prevailing view that China overtaking the US as the world's biggest economy in dollar terms, not in PPP terms, where it is already ahead by some measures, is not only inevitable, but perhaps imminent. And yet all the problems which fueled the bearish mood in 2002 are still there today, and if anything even larger: demographics, non-performing loans, real estate problems, exercised control by the party, making entrepreneurship more difficult. If anything, that situation has got significantly more so over the last 5 years. And on top of that, you have this US semi-blockade of China and this determination to contain China. So the idea that China could become peak China around 2025, and that from that moment on, it's going to go into relative, if not absolute decline, caught in the middle income trap, is far from implausible in my view. It's not inevitable. Demographics are not destiny, for example, contrary to one cliche which gets trotted out from time to time. But if we look at Asia as a whole today and consider the growth of Asian economies since the 1950s, very, very few of them have actually managed to escape definitively the middle income trap. And China will have a big fight on its hand to do so. 2025, I think, is going to be quite a tricky year irrespective. We do have a US presidential election. It is well established that America's adversaries on the global stage like to test a new president. We might see Joe Biden back in the White House in 2025, but frankly, I doubt it, which is not to say I think it's going to be Donald Trump. I'm saying if it is a Democratic president again, it may not be Joe Biden. It could be another Democratic candidate yet to be identified. It could be a Republican, of course, and if it's a Republican, it's not necessarily going to be Trump. Too soon to tell. Let's get the midterms out of the way in November and then take stock of prospects for the 2024 US election. Less well known is the fact that there's a Taiwanese election in 2024. And Tsai Ing-wen, who is reasonably moderate by the standards of her DPP, will not be able to stand for a third term. She could be succeeded by one of her party members who is more determined on formal independence from China and thereby sparks a real crisis in 2025. So we have all these factors coming into play, and I think realistically we need to be very cautious as things stand and as we can reasonably project them over the next 3 years on the prospects for China, Taiwan and conflict in 2025. And just to go back to the book and the way in which you phrased the question, if we do see this happen and China is indeed at its peak powers at that time, this too will have an echo with Russia's actions in Ukraine today.
In your final slide, you described the current situation as a perfect storm. Is the worst still to come?
Yes, almost certainly. And if we consider that this winter is going to be particularly tough in Europe, this is Putin's moment of maximum leverage. He will do whatever he can to try to break down European unity in order to try to improve his chances of something which he could reasonably call victory in Ukraine. And it is going to be tough in Europe. There is no question about it. As the famous words go, winter is coming. And it will be a tough winter indeed. And it won't just be energy prices which are frozen in Europe. whole economies could be effectively frozen by inflation, a dragon which central bankers thought they had slain years ago, but which is now back and breathing fire. So it's going to be a very tough winter in Europe. I think Europe will get through it, as I said earlier, but then Europe is going to be faced with the task of preparing itself for the following winter, probably with even lower gas reserves than it started with in preparing for the immediate winter. American politics are going to continue to be difficult. I'm kind of still very reluctant to make predictions about the midterm elections in the US. It doesn't look like it's going to be the red wave which we thought it would be a few months ago, but American politics, irrespective of the outcome of the midterms, are going to remain sclerotic. They're going to continue to revolve around Donald Trump for the foreseeable future, whether he is indicted or not. And that polarization in America is going to continue, and clearly that is going to add to the general tensions. It's going to take Europe quite a while to get back firmly on its feet economically, irrespective of what happens on the ground in Ukraine. And it may be that we are simply going to run from one crisis into the next crisis, which has pretty much been the way of things since subprime in 2007. If we think about it, it has been a succession of crises, each one different to the previous one, each one in its way a little bit worse than the previous one. You may recall that in the video we did back in May, I featured Martin Wolf's analogy of the four horsemen of the apocalypse: famine, war, plague and death. And we do still seem to be in a world today where the four horsemen of the apocalypse are out there and riding hard in our general direction. So yes, I think the worst is to come, but I also think it's worth bearing in mind a famous quote from Rahm Emanuel, former mayor of Chicago, advisor to Barack Obama: never let a good crisis go to waste. And I have to say, to go back to what we were discussing earlier, that so far the European Union does seem to have been making this crisis into an opportunity to continue to advance the cohesion of Europe. And that is the bright note with which I would like to leave the LFMA members today, that it's not all doom and gloom. The clouds are heavy, but there may just be something of a silver lining up there for deeper economic and political integration in Europe, which ultimately will be of benefit to the continent as a whole.
Dear Alastair, on behalf of LFMA members, I would like to thank you for being with us today. And I can definitely dare to say that our members have a better understanding of what they can expect in the near future.
Well, thank you very much, Vincenzo. It's been a real pleasure to be here, to do more work with you and your members, and a privilege to be involved in the 65th anniversary celebrations of the LFMA, a remarkable achievement. I'd like to wish the LFMA, its members, all the very best for this anniversary and for the next 65 years. I won't be around to celebrate your 130th anniversary, but maybe I'll be back for your 70th anniversary, if not before. Thank you so much.
Thank you.